we're in a bit of trouble. The markets have been holding up fairly decently as of late. And I've talked about this repeatedly. I said we've got a big cluster of support, and the markets are holding in there. We had broken the 100-day moving average on Monday. Then we got lots of talk from White House advisors coming out saying, oh, no, don't worry about the China thing. It's all fine. Markets rebounded. Overnight, we got more commentary from Steve Mnuchin saying, yeah, we're going to work with China. Markets were up about 22 points at one juncture today. And then Larry Kudlow comes out and flaps his gums, and this is the guy that I may have and I think the way Larry Kudlow is going, he may have a very short career in the White House, because if he keeps messing up the market, I don't think Donald Trump's going to keep him around for very long. So his career will be kind of a short tenure. But he comes out today and he says, no, we're taking a hardline stance with China, not letting them get away with anything. Markets do not like that. While the markets only finished down today about 22 points, it was actually about a 40-point swing in the markets today from highs to lows. So it was a much bigger sell-off than it looked like. And the bad news is that we broke all this kind of cluster of support that we've been talking about lately. We broke the 50-day, we broke the 100-day, and the only positive news this moment is we're still sitting on the bullish trend line that really started back in late April, early May. We are sitting on that currently, and we need to hold that through Friday. So this market has got to get its act underneath itself. Now, I'll tell you, we've had several straight days of sell-offs. We've had basically 5-6 days of sell-offs. That's a very long stretch of sell-offs to go back to back. I would suspect that we're going to get a fairly nice rally tomorrow and Friday. The goal here, though, is we've got to get back above this 50 and 100-day moving average by Friday to reverse this action of today. So my point is there's nothing to worry about today, right this minute. Don't go out tomorrow and start selling a bunch of stuff. All this is a warning right now. But this breakdown is not a good sign at all. And if this market doesn't heal itself up by Friday, we've got potentially bigger issues ahead of us. I also want to talk to you about one other thing. We've talked about for a while that in our portfolios, we have been maintaining a heavier weight in fixed income and cash. We're about 50% stocks, cash and bonds, and we're a bit underweight in equities right now. But bonds have had a very, very nice recovery, and I've been talking about this for the last couple of months, is watching this bottoming process in bonds, and that is exactly what has happened. And not only that, we are about to break above, theoretically, back above the 50-day moving average. Now this changes the whole, the 200-day moving average on bonds. This is changing the dynamics. We closed today at 2.82% on the 10-year Treasury, down from over 3% just a month or so ago. What this is telling you, what this advance in bonds is telling you, is that this whole inflation story, etc., that people have been talking about is only transient from the impact of oil prices. Outside of that, we saw durable goods orders today down sharply. Auto manufacturing getting hit hard. Existing home sales down much more than expected. And what's all that tied to? Interest rates. Interest rates have been going up. People buy payments. They don't buy houses and cars and other stuff. They buy payments. And when interest rates go up, it ceases their ability to buy stuff because they don't have a lot of discretionary capability. This is why the savings rate in the country right now is at its historic lows. We've got people with less than $500 in emergency savings in the bank. They're strapped out on credit cards. Interest payments make a big difference. So when interest rates move up, it adjusts the rate of payments, particularly in variable rate credit cards, subprime auto loans, adjustable rate mortgages, etc. It impacts their ability to consume goods. And in an economy that is very late stage, you see that impact very quickly. And that's what's going on right now. And you're seeing the reversion here as money's moving kind of this rotation from risk into safety. And we're seeing that really kind of across several different areas of the markets. One of the big risk-on trades lately has been in technology. We're seeing money come out of tech lately because of this issue with China and on Chinese investment into technology companies. We're also seeing a rotation coming out of banks. This is a little bit interesting in terms of banks. Take a look at JP Morgan as an example. We take a look at Bank of America as another good example. These stocks are under a lot of pressure right now. And this is Bank of America. Taking a look at it, but all these bank stocks look exactly the same right now. JP Morgan, Bank of America, Goldman Sachs. They all have the same exact chart pattern. Now, interest rates going up means they make more net interest margin. their net interest margin's going up, they're making more money. Their fundamental balance sheet looks very good right now. But why is this happening with the banks? It has everything to do with the yield curve. Yield curve has been getting crushed, and with interest rates in the 10-year Treasury falling now to 2.82% and interest rates on the short end going up because of the Fed, the flattening of the yield curve is getting very, very close to actually being zero, and that's a big concern because an inverted yield curve typically leads to recessionary impacts in the economy. More importantly, not just the yield curve of government rates, the yield curve on corporate borrowing is already negative, which means that the cost of borrowing is higher than the rate of return that corporations can get from borrowed capital. This completely derails the whole idea of CapEx and companies spending money in the markets, building out plant, property, equipment, etc. And we saw that today also in core durable goods, which is a good measure of CapEx. Where are people spending money, particularly on the company or corporate side of this? And we saw a decline in CapEx spending. So you're seeing this already impact. Rising interest rates are a negative for the economy. While people have dismissed this a lot through history, rising interest rates, the Fed, have always been precursors to recessions and economic slowdowns. Again, as I've been saying before, while the market's been holding here as of late, the risk going forward is much greater than people expect. This is why we have insurance on our cars, we have insurance on our house in case something goes wrong, and this is why we have a sell discipline and we have insurance in our portfolios in case something goes wrong. We want markets to go up, we want to be long-term investors, but we're also managing that downside risk. So if you don't have a strategy, we encourage you to get one. We've got articles on our website about portfolio strategies, how to manage risk, and if you need help, simply schedule an appointment or send us an email. Richard, myself, Danny Ratliff, John, Jesse, the whole group is happy here to help you. So simply go by the website, realinvestmentadvice.com. Let us know what we can do for you, and we'll be right back after the break. Talk about unions, and that union pension, and why you probably need to be thinking about it. We'll come back after the break and talk about it.
Follow Lance on Twitter @LanceRoberts or go to realinvestmentadvice.com.